Thanks for tuning into Talking Point. I'm your host, Neeraj Char. Guest today is Rajeev Thakkar of PPFAS AMC, and he's written a lovely note to his unit holders. And we are going to be talking to Rajeev on some of the key excerpts of the note, because I think there's great wisdom out there for investors and traders alike. And Rajeev, thank you so much for joining in and giving us your time. I want to start off by using a few of the things that you've written on the note and start off with the first one, wherein you're making this point at the very initial part of your letter. Then stocks can have extended periods of sub-fixed income instrument returns, and in some cases, negative returns as well. Rajeev, why is this such an important point to be made at this juncture of the markets?
Sure, Neeraj. So, friends, relatives, people who we know, of late there has been this chatter. So, just this Diwali season, we were meeting various friends and relatives. So, someone came up to me and said, I have this money which we have kept aside for buying a home, and markets are doing good. So, where do I put it? Meaning, I may need it in 6 months, I may need it in 8 months, but show me a way where I can make good returns, and banks will give me whatever 7.5% per annum. Stock markets will give that in maybe a few months. So why wait in fixed income instruments? So this past returns have changed behavior of investors. Investors are now taking it for granted that for any time horizon, you can come to equities and you can make positive returns. I think that is something which is, to my mind, a worrying sign, and people should consider that equity as an asset class is only meant for longer term investments.
Yeah, and I think there is a very nice view that therefore comes in when Rajeev speaks about this. And again, I'll use that quote which I've picked up from the note itself, wherein he's saying that only put that money into equities that investors can preferably not touch for a decade or at least 5 years at the minimum. Now, Rajeev, that's a very long time frame for people who have come into the markets in the last 4 years and have seen decades compressed into months or quarters, if you will. 5 years and 10 years seems almost impossible to a lot of investors currently.
Yes, Neeraj. So this is the dichotomy. People buy a home and will live in that for their entire lives, or will pass it generation to generation. People will buy gold jewelry, and that will be in the lockers and again get passed on to the next gen. People will put money in EPFO, start at 25 years of age, and keep investing till they are 60. People will pay life insurance premiums for decades. But equity as an asset class, which technically has no maturity date. So unlike bonds, which have a fixed maturity and they have to pay back principal at a certain point in time, equity have no such thing. Still, people have the shortest patience and shortest time horizon for equity, which I think, as you said, years and decades have been compressed into days and months in the recent past. I think that has changed investor behavior, and I think it will not end well for people who are looking for a quick buck from the market.
Rajeev, do you believe that we have now entered a phase wherein the market behavior of the last 3-4 years has changed, wherein the returns, the way they come, will be different than the last 4 in which there was instant gratification, near instant gratification? You think that has changed now?
So one, the nature of the market clearly has changed. We have seen tremendous increase in F&O volumes, and there is a SEBI study which has been, which is in the public domain, which talks about the huge losses that so-called investors have made speculating in F&O all the time. There has been reduction in number of contracts and things like that. So obviously the nature of the market has changed, and in a market which as such only goes up, the shortest dip is taken as a buying opportunity, and people will buy all sorts of companies, all sorts of valuations, and still come out ahead. Now that cannot continue forever. So to that extent, only if the right stocks have been bought at the right valuations, will you see returns. Otherwise, we have already seen people losing some money in this 10 odd percent correction that we have seen in the mainstream indices, but individual stocks have fallen much more. So you will see that kind of dichotomy. So we keep talking about K-shaped recovery in the economy. You could see K-shaped stock returns as well. Things which are not bought sensibly could give you negative returns.
Yeah, well, a lot of wisdom out there, not bought sensibly, and I think that should be kept in mind for sure. Now, Rajeev, in his note, has also used some of the lessons from Benjamin Graham, and one of the notes, no, this is not Rajeev's view, by the way, this is Ben Graham's view, and Ben Graham has said that and this, by the way, viewers, this is in reference to the mushrooming of thematic funds, and which is why I think this is important. So Ben Graham says, ignore that Rajeev Thakkar's view, but Ben Graham says that the experts do not have a dependable way of selecting and concentrating on the most promising companies in the most promising industries. Now, Rajeev, this becomes important in this, in that the number of thematic funds that have come in and the kind of subscription these funds are getting is high. You think it is not desirable, if you will, from an investor perspective, that such high set of flows are going into thematic funds?
So, Neeraj, what happens is when you buy a sector fund or when you buy a thematic fund, for the fund manager, the options become limited in terms of the number of companies that fund manager can buy, and also the uh, limits per company and all are fairly liberal as compared to a diversified equity fund. So you will have situations where your entire investment is in one sector, and if that sector were to go into a downturn, you could face heavy losses as compared to a diversified equity fund. Now, a diversified equity fund will also get affected in a downturn, but the impact will be muted. So, for example, in one sector, if things come down by 50%, that sector will also be part of a diversified fund, but maybe the exposure could be 10%, in which case the impact on the portfolio level will be much muted. Now, the challenge becomes that investors get drawn to a particular sector only after that sector has had a very strong run in the past. So most of the positives are already in the price. We have seen in the past, in the late 90s or early 2000, the tech funds were getting a lot of inflows. In 2007, we saw infrastructure funds and real estate funds getting a lot of flows. So typically what happens is people rush into an asset class which has done well off late and then end up buying at very, very high levels.
Okay, well, then tied into this is a very interesting piece that Rajeev writes, that be mindful of valuations. Now, because Rajeev said that people tend to get into thematic funds only after a lot of performance has happened. Maybe if you get into thematic funds earlier and if you are a savvy investor, it might not be a bad idea, but generally that doesn't happen. And therefore, en masse, ignoring valuations can lead to subpar returns in the future. Now, just before I go to Rajeev on this, the lovely case study, and I just want to bring it out as well, and we'll play it, of course, when Rajeev is giving his answers. But look at this that they've provided, an Infosys case study. I'm calling it the Infosys case study, that profits of Infosys were around 265 crores in March 2000. Profits grew to about 6,200 crores by March 2020. That's nearly a 22 or 23 times uptick in profits. But guess what? Look at the returns in the stock price. March 2000, it was 140. March 2004, in this period when the profits were growing, the stock actually went down to 82 and gave nearly 40% negative returns. March 2009, nearly at the end of the period, is when the stock recouped and came back to the levels that it was at with about a 19% return. And March 26, 2010, which is the 10-year period, it was still only 346 rupees, which is 147%. In isolation, looks good. Over a 10-year period, even non-compounded, the returns are not that great. Compounded, very, very meager returns. Rajeev, do you sense that market-wide as well, this is the problem currently, that valuations are very expensive, or the recent correction brings the valuations a bit more, makes the valuations a bit more sane?
So let's look at one of the favorite themes of investors and one of the most talked about things about India is the huge uh, young population, and we will, as our incomes rise, we will consume a lot more. So anything and everything linked to consumption. So based on that, we have driven up valuations of FMCG companies. Based on that same story, we have driven up valuations of big box retailers. We have driven up valuations of e-commerce companies. We have driven up valuations of quick commerce companies. Plus, you have ONDC coming in, which is trying to unbundle the whole thing. Now, everything cannot be at 50, 100, and 200 times earnings. Uh, we are excited about big box retailers because they can bring in their private labels. We are also excited about D2C brands, brands which are born on the internet and born on e-commerce. Now, everything has triple digit earnings multiples, or in some cases, there are no earnings at all. Now, the gains of one entity will come at the expense of the other entity. So I'm not saying individual companies will not be winners or money cannot be made here, but one has to be selective. It's not that Indian consumption story will lift all boats. Again, let's say recently, paints is a sector which is exciting. There are some very high quality companies out there in the paint sector, but two or three other big players have entered in that segment, and which is putting pressure on volume growth for existing players and on margins. So, which is the thing about high growth? Any sector which seems high growth and which seems promising, a lot of people enter and competition ramps up. So, you cannot just ignore everything and just invest based on the consumption story or the growth story.
And Rajiv, which probably explains why maybe you are, for lack of a better word, a more conservative investor. When you give due importance to valuations, a lot of questions asked about your cash levels as well. You waiting for the right time and the right valuation to deploy the cash, as opposed to chasing high valuations and high growth.
So we are waiting for four stocks to come by. So if we have 20% cash and four stocks come our way, we could put 5% each and run out of cash. So it's not that we are waiting for a particular index level or for some particular geopolitical event to play out or something like that. It's just that opportunities are hard to come by. So a corollary that people ask is, why don't you buy more of what you already own? Now, there is a certain weightage that you can give to a particular stock in the portfolio construct. Uh, for example, if we like private sector banks, we cannot have 100% of the portfolio in private sector banks. So there are constraints in that sense. So as and when opportunities come, we will deploy. But I think given the rise in some of the companies, 10% is neither here nor there. It doesn't really change the valuations that much in some of the sectors.
Got it. Rajiv, lovely talking to you today. Thank you so much for being with us, and lovely note written. I'm sure a lot of you unit holders will be eagerly waiting to attend the December 14th meet that you have. It's a bit of an annual fest. So, yep, all the best for that as well. Thanks so much for speaking to us today.
Thanks.
Right. That's the view from Rajeev Thakkar of PPFAS, and lovely note written, by the way. It's a great read, independent of that. I think we will probably have a story on that note also on our website, so you might want to go in and try and read up on that as well.